Welcome to this explainer. Today, we're diving deep into the actual machinery of federal tax reporting and how retroactive amendments really work. We're not just going to talk about which boxes to check, we're analyzing the whole computational framework. We'll look at the cause and effect relationships of statutory modifiers and the strict timelines for fixing historical data. If you want to understand the true mechanics beneath the surface of tax compliance and pull out some truly actionable insights, you're in exactly the right place. Okay, so here's our roadmap for today. Section 1 is all about the anatomy of the baseline form. Then in Section 2, we'll hit modifiers and adjusted income. Section 3 covers the mechanics of amendment, and we'll wrap up with Section 4 on temporal and procedural constraints. Let's get right into it. Section 1, Anatomy of the Baseline Form. This is the primary personal federal reporting document. Before we can even think about retroactive amendments, we've got to deconstruct the primary document itself, right? This form is literally the foundation for all federal personal income tax assessments. It's not just a piece of paperwork. Think of it as a rigid structure built to translate the economic reality of millions of people into one standardized computable language. And it flows in a very strict chronological sequence. It kicks off with core identification, your name, your numbers, permanently linking you to the federal databases. Then, boom, right into filing status protocols. From there, it pulls in your income consolidation, applies specific deduction fields, and finally spits out your final liability or refund calculation. Now, what's absolutely crucial to grasp here is that those first 2 points, identification and filing status, are the non-negotiable variables that dictate the entire logical flow of everything that follows. Let's look closer at that filing status. It is the foundational variable. Whether you're single, joint, separate, head of household, or a qualifying survivor, you know this isn't just an administrative checkbox. It's the ultimate cause that triggers very specific downstream effects throughout the rest of your reporting. It permanently locks in the thresholds for your standard deduction and drops you into highly specific tiered brackets. Honestly, a single error right here completely invalidates the logic of the rest of the document. Understanding this dependency is massive because it really shows how your earliest decisions in the sequence constrain all your subsequent financial optimizations. So once you've got that rigid foundation locked in, it brings up a pretty crucial question. How do emerging statutory changes systematically alter these foundational metrics? Because as we all know, the tax code is definitely not static. It's a constantly shifting landscape of legislative updates, and these changes introduce new variables into that initial formula, creating both strategic opportunities and, honestly, some hidden compliance risks. Moving on to Section 2, Modifiers and Adjusted Income. Let's look at applying those statutory variables. Okay, so once your gross income is declared, you're obviously not just paying a flat percentage. The framework applies a series of what we call statutory modifiers. These are recently enacted variables that fundamentally change the trajectory of your adjusted income, and they often target highly specific economic behaviors. Just look at how hyper-targeted these are. We're not just talking about a broad standard deduction anymore. We've got a senior bonus deduction specifically for folks 65 and older. There's one shielding qualified overtime pay for eligible middle income earners, and a qualified tip deduction isolating employer-reported tips for service industry professionals. There's even a hyper-focused auto loan interest deduction. The whole point of each of these is to aggressively reduce your taxable base. But, and this is a big but, only if you meet incredibly strict localized criteria. It really shifts the burden from simple income reporting to actively navigating complex behavioral incentives. And if you misinterpret the criteria, well, that creates immediate liability. The key here is understanding the scale and the sheer specificity of these new modifiers. Take the number 10,000, for example. That represents the actionable threshold, up to $10,000, for the newly introduced auto loan interest deduction. But here's the non-obvious, implicit catch. This isn't for just any car purchase. The mechanistic criteria demand that the vehicle meets highly specific domestic assembly standards. It's basically a behavioral incentive perfectly disguised as a computational modifier. It alters your final tax liability based purely on consumer choices you made completely outside the tax period. So if those domestic assembly criteria aren't met exactly, claiming this modifier introduces a significant, easily auditable vulnerability into your filing. Similarly, let's look at the number 6,000. This represents the $6,000 senior bonus deduction. Now, what's really fascinating from an analytical standpoint is how this specific limited time below the line deduction interacts with standard income thresholds. It actually stacks directly on top of existing age-based standard deduction increases. So you get this powerful compounding effect. It drastically lowers the adjusted gross income for a very specific demographic, effectively sheltering a much larger chunk of fixed income. But again, failing to apply this modifier correctly leaves thousands of dollars exposed. It really highlights the rigid penalty for misunderstanding how standard allowances interact with these targeted variables. All right, Section 3, the mechanics of amendment. Let's talk about reconciling historical data. So what exactly happens when complex modifiers are misapplied, or you just simply forget to include some initial data? Well, the system mandates a highly specialized amended protocol. The amendment document operates on a super strict tri-column architecture. Column A requires you to lock in the original data exactly as you filed it previously, no changes. Column B is what we call the delta, the exact net change. And column C is the reconciled sum. This format forces a very clinical reconciliation of your historical records. You can't just hide a mistake or overwrite it. You have to clearly isolate the old data, explicitly state the variance right there in the middle, and computationally prove the new total. This structural transparency is exactly how auditors instantly spot discrepancies without having to manually recalculate your entire return. Let's zoom in on column B for a second, the delta. This is the precise mathematical variance, positive or negative, that actually necessitates the amendment in the first place. The entire corrective process is driven by this single column. When revenue authorities review an amended filing, their scrutiny zeroes in right here. The delta is the targeted anomaly in your record, and the burden is entirely on you, the taxpayer, to justify exactly why that variance exists. An unverified delta is literally the primary trigger for prolonged manual reviews. That makes it the absolute highest risk variable in the whole reconciliation workflow. To actually execute this correction, the framework forces you into a rigid 4-step protocol. Step 1, identify the missing deduction or unreported income. Step 2, calculate the exact variance for the delta in column B. Step 3, compute the final sum for column C. Simple enough, right? But step 4 is the critical bottleneck where most rejections actually happen. You are procedurally mandated to attach the revised supplementary schedules that justify the variance. So if you claim a $1,000 variance in charitable deductions in column B, you can't just write that on the main form and call it a day. You have to attach the newly revised specific itemized schedule that explicitly proves that $1,000 delta. The primary form and the supplementary schedules have to align flawlessly. If they don't, the amendment is automatically flagged as invalid, which creates massive processing friction. Which brings us to Section 4, Temporal and Procedural Constraints. Let's dig into statutory limitations and processing protocols. Now, even if your calculations are absolutely perfect, the system operates on these rigid intersecting timelines and some pretty non-obvious constraints. You don't just have infinite time to correct historical data. Here is the defining rule. The framework uses a dual statute of limitations for amendments. You have exactly 3 years from the original filing date or 2 years from the date the tax was actually paid. And the really crucial point here is that the system honors whichever of those 2 deadlines occurs later. This bifurcated timeline is highly strategic. It protects folks who might have been on delayed payment schedules, making sure their right to reconcile data isn't artificially cut short just based on the original filing date. Building on that, there is a totally counterintuitive rule baked into this timeline regarding early submissions. Early filings are legally treated as if they were filed exactly on the official tax deadline. So if you're a super proactive filer who submits your primary form, say, 2 months early, the system does not punish you by starting your 3-year look-back clock early. No way. The countdown is universally anchored to the official deadline date. This sets up a standardized temporal baseline for everyone, preventing early filers from accidentally giving up months of their legal amendment window. Okay, now we really need to deconstruct a major procedural trap. A paper-filed original return strictly nullifies electronic amendment options. This is a profound cause and effect relationship when it comes to the digital infrastructure. If the cause is filing your initial document physically on paper, the irreversible effect is that your subsequent amendment must also be processed on paper. Why? Well, the digital infrastructure needs a digital original record to perfectly map that delta we talked about earlier. Without it, the system can't computationally verify the changes against an existing database. So it forces you entirely into these slow-moving, manual processing streams. It is absolutely a hidden, compounding penalty for analog reporting. Furthermore, even if you exist completely within the digital ecosystem, electronic amendments are still strictly constrained. The digital infrastructure only allows amendments for the current tax period and the 2 immediately preceding periods. That represents a rolling 3-year digital look-back window. Any authorized amendment that falls outside of this window, even if it's legally allowed because of a delayed payment schedule, has to revert to physical, paper-based processing. Knowing this limitation is absolutely crucial for tax planning, because waiting until the absolute end of your legal window often means you have to sacrifice the speed, tracking, and security of digital reconciliation. And because manual reviews of these deltas are inherently rigorous, we have to map out the actual reality of the timeline, from submission all the way to final ledger reconciliation. Hint, it is never instantaneous. 8 weeks? That is merely the initial processing benchmark. It's essentially just the system confirming, hey, we received it. 12 weeks is the standard resolution window for straightforward, well-documented changes. And in cases where your delta requires complex verification, or if it triggers a secondary review, the process extends to a maximum threshold of 16 weeks. Understanding these rigid intervals is great because it prevents panic and sets clinical, realistic expectations for how long this bureaucratic machinery actually takes to digest and approve a retroactive change. So we've deconstructed the primary form, analyzed those hyper-targeted modifiers, mapped out the tri-column amendment architecture, and outlined the rigid procedural timelines. To wrap up this analysis, I want to leave you with a pretty provocative thought. If the mathematical architecture of tax reporting is this rigidly interconnected, what latent risks reside in the modifiers we enthusiastically choose to claim today? Think about it. A single foundational error, or maybe a misunderstood demographic modifier, doesn't just affect one single form. It can cascade through years of procedural amendments, triggering intense scrutiny on your specific delta. It really forces you to think carefully about the variables you introduce into your equation. Thank you so much for joining this explainer, and keep learning.